Tell us your view of the story of Austin as a tech corridor, innovation hub.
So really, I mean, we were more of a hardware. I mean, this was a big semiconductor city. I mean, in some ways it still kind of is, but it was big hardware, big computers, big semiconductor. On the software side, there was the Tivoli. I mean, there's National Instruments, which there's some of the testing companies. There's VMware. There's plenty here now, but it wasn't always like that. It was more of a hardware, firmware with some software that supported them starting to come into the space. That all changed, and then there just wasn't much capital democratization. There were sort of two funds that kind of covered Austin. And if you actually talk to the West Coast like fund managers of that vintage, I mean, I've had a couple that are mentors to me. I think it's really important for any founder of any business is find somebody who's walked the trail ahead of you and kind of learn their wisdom and serve them and so it was kind of considered a tier two city for all the right reasons, right? We just didn't have the density of founders, of executives to have enough critical mass to where they would plant a flag here. And so it was kind of cute and known, but not necessarily obvious. And you wouldn't spend a lot of energy on it because there's so much stuff in your own backyard. How that really changed, though, is I think people started moving here on the operator side, right? So the talent started coming, and then it started coming, and then the big company. This is Oracle's headquarters now, right? I mean, they're bigger
Yeah.
here than they are in California. I think it's like second city most for Google, Facebook, drop. I mean, test
By the way,
all.
that is just so important because like you can be like, okay, I'm Emmanuel Macron. I'm going to overnight give tax breaks to anyone that puts money in a VC fund or a startup. And overnight, you've got 200 new freshly minted VCs in Paris. But who's going to buy those companies? Show me the
Right.
big balance sheet buyer. Show me that spiral of like Austin, I think, has always been good at enterprise software where they know how to like raise some money. Maybe they got it in California in the old days or AV here. And then they get some logos, they show some traction, they go back and raise at a higher valuation, they spend more, they build more, and it kind of upward spirals like that. But who's going to buy your company if all the buyers are in Silicon Valley and Seattle? It's less likely that they hear about you at like a lacrosse game with their kids and all that. Now we've got Oracle, one of the biggest buyers of not only enterprise but consumer companies, and they have their M&A corp dev team here in Austin. That was a big signal, seeing those guys move.
Totally agree. And I mean, I remember the days, back when I was an operator, it would be a term sheet contingent upon relocation, right? So here's your Series A, you got to move your team to Austin, or Series B, but you've got to move most of the team to Austin and take the nerd bird, every Monday and come back Friday kind of thing. So it was a real thing. Like if you want our money, you're coming here. And it absolutely flipped to now it's, oh, by the way, when does your lease expire? Can you take more real estate? Can you build your team there and actually take people out of, California? So it's really interesting how the pendulum completely swung. But and you said, you're right. I mean, the muscle memory here of this town was very much an enterprise software town and, kind of hardware semiconductors.
Hello, and welcome to Fireside with VC. My name is Andrew Romans, and I'm here today with my good buddy in Austin, Texas, Chris Shonk, who is a co-founder and general partner of ATX Venture Partners. Chris, great to see you.
Nice to see you, Andrew.
Describe how we first met, if you remember.
I do. We met in Miami at one of these LPGP, kind of get together things and went down the rabbit hole talking to different allocators and found out we were both fund managers and both early stage and, global travelers. And I remember we kind of pretty quickly sort of made a left turn and just went up to the bar and got a nice bourbon and sat there talking about all kinds of interesting stuff. So that was actually, I think, kind of the highlight of the night for me. Just, when you meet somebody who's super interesting, that gets your wheels turning and you leave, you feel like it's just additive, right?
Yeah.
Socially additive, intellectually additive, professionally additive. The other stuff is kind of, more the same. Oh, what are your thoughts on, SaaS for this, or what's the market like in, my Austin versus Bay Area or whatever. So I really enjoyed our conversation. Yeah.
Yeah, I actually remember there was going from like an event to event. There was some rooftop thing, and then we got into one of those big, where you have like 6 kids car things, Ubers. And I didn't even see you. You were like in the deep back. And I don't know, we're talking about Unix or something. And I was like, dude, this is the guy right here. I'm going to talk to this guy. So by the time we got out of the cab, that was the first time I saw you, really. And we were already in this kind of group conversation. So that was really fun. But I now remember back then telling you that I'm thinking of moving to Austin, Texas and leaving Silicon Valley. And this is long before COVID. So when
You
I
were ahead of the
finally,
curve, man. You were a visionary for sure. I do remember that clown car, and it's funny you play it back. It felt like a clown car of, VPs, LPs, consultants all shuffled together and elbows in somebody else's side and kind of all that, right?
That's right. Okay, so I want to get in this episode and talk about Austin, Texas, ATX Venture Partners, but a quick word from my buddy Mark. Okay. So, Chris, I know, didn't you start off, you were in the US Army, right? In the very, very beginning?
That's right. Yeah. After, before my professional career, I guess business career, I was in the military. That's right.
Yeah. So why don't you give us a quick walk up? And I know you had like, was it Clever Games or Sneaky Games? You had that IPO.
Yeah.
So you're operator turned VC. So let's hear about the operator stuff first. And with all my startups, I remember I hired a guy who was an ex-Marine. And the guy was like, yes, sir, no, sir, getting shit done. And I was like, this works for me. So I've had really good experiences of having just employees that, had US military background.
Yeah. So mine, I'm the oldest of 8 kids, grew up in kind of the burbs in Houston and, Gen Xer. So kind of a product of that, A-Team TV show and, Pretty Woman, Wall Street, kind of all these, Rambo was the thing. And so, growing up, it was like, hey, it'd be neat to jump out of planes and learn to scuba dive and blow stuff up. And, I wanted to get out of Houston. I mean, it's a great, big, hot metropolis, right? And, see the world. And that was only going to happen if I, won the lottery or joined the military or, did join the Peace Corps or something like that. So joined the military and, told them, you take all these different barrage of tests. And after kind of getting through that, they're like, well, you can do anything you want. And I was like, well, fantastic. I want the hardest, craziest, wildest stuff you've got. Because if you're going to own me for 4 years, I want this to be an even value exchange, right? So that's what I did. So I basically was in school for 2 years, getting all kinds of training. Got to go to South America multiple times, made a lot of good friends, learned a ton at the time that I didn't appreciate. How transferable and unique some of the stuff you learn in the military is. And then that served me well as both an entrepreneur and an operator founder as I was building out other organizations in the technology side. And then it's also really reared its head in standing up a venture fund and the business of being a fund manager, and then going from player to coach, if you will, to help other operators build companies. So it has been, the gift that keeps on giving, much more so than I think undergrad and even grad school in some regards.
Yeah, I believe that. And so tell me about your startup experience. Was it Sneaky Games, something like that? What was the name of
Yeah, so we had
you had a couple companies.
Yeah, 3 different startups kind of in chronologically, and then I had a fund as well. So after military, investment banking, Merrill Lynch, consumer services and retail, right as the .coms were starting to take off. So as the internet was in sort of, the first wave of being a thing, mobile wasn't around yet. And so did that, 99 to kind of end of 99 to sort of 2000, 2001. And then boom, the dumpster fire, right? So .com, everybody retreated. I went to grad school. Either because big tech blew up, which blew up high finance. So everybody junior left because all the work that was available was being gathered up by senior partners and managing directors, right? It was time to look busy, if you remember.
Yeah.
And so everybody went to either law school or grad school. I really fell in love with Austin, went to grad school here. And what I realized was like, hey, I need to be technical. A lot of people in my class were engineers from big tech that got laid off, and they were turning from engineers into sort of business engineers. I was turning from, kind of military operator, problem solver, organizational kind of leader to more, and then I had the financial from, being an analyst a bit to more like, all right, well, how does tech play with finance, play with ops, and
Yeah.
got a little bit technical after that as well, and then went out and launched 3 different companies in a fund. So my first job after grad school was actually
By the way, can I just say that when the .com, ripper was going up and everyone was getting rich by changing their name to something.com and IPOing, all of Harvard, Stanford, Wharton did not want to go into banking or consulting. They all wanted to be Zuckerberg, rich overnight, internet millionaire. It's like, Bitcoin idiot who did nothing but speculate. And then the music stopped. No one was getting funded. Everyone was getting fired. And people were saying, the joke was, you know what B2B stands for now? Back to banking. You know what B2C stands for? Back to consulting. So it's like everyone's just trying to get into McKinsey and Goldman, as opposed to like, I'm not going to Goldman or McKinsey. Hell no.
That's so funny. No, that's exactly what it was. My whole class was like, I need to retool my resume because I'm done with this tech founder early hire executive thing. I want to go, like you said, be a consultant or banker. I was literally running the opposite direction. So after grad school, I got called up by a couple buddies, and they thought Austin was on fire. I really wanted to apply kind of a technology innovation approach to some kind of hard asset with yield. I really, all these case studies in grad school, there's kind of 2 ways to think about something. There's taking something that's perceived as risky with a lot of economic opportunity, and then de-risking that, right?
Mm-hmm.
So, and then there's sort of the safe, steady, thing, and then adding a next chapter or a second act or unlocking more economic upside. So those are kind of the 2 ways where you can get paid for the risk, because you either take something risky with great potential and make it less risky, or you take something that is already right sized as far as risk and reward and relatively low risk, and then adding e-commerce or expanding the market or dropping on a new product or something like that.
Okay.
I kind of looked at that, and having come out of just this dumpster fire of the .coms, I thought that the latter was actually a more pragmatic approach, because it was still a washout. Like there was still a lot of carnage and people weren't ready for the swing for the fences story. And I thought there was a lot of both money and talent that would resonate for hey, this is safe, but it's actually going to be even more interesting if we can drop some tech or bring it online or bring in some mobile or whatever it might be. And so I ended up teaming up with some friends, and we launched a firm called Virtus. So Virtus is still around. It's a real estate firm that managed about 4 billion in AUM. And I was one of the 3 founding GPs there. It was this super non-sexy. I mean, we were early to storage units. We were early to student housing, medical office buildings, what's now called kind of workforce housing. Those were sort of our demographic thematic assets. And then at the end of the day, you and I know there's lots of funds, there's lots of ways to make money, even with, this is before prop tech was a thing, even with tech for real estate and doing some interesting things, it's still real estate. And there's nothing wrong with it. I still have a lot of real estate in my personal portfolio, but it's a great way to protect wealth. It takes a long time to really achieve wealth, unless you're using, significant other people's money or something like that. And it just wasn't my passion, right? I mean, some people love real estate. To me, it was a vehicle. And so I sold out of there about 2 years after, and I'm still a special limited emeritus and have, a good representation in Virtus. And it's great. It's actually a good barbell to tech. It's just slow, safe asset back yield, because everything else that, we VCs do is longer hold, illiquid, high returning capital gain stuff. So you got to have some way to smooth it out, especially if you're married with kids, and, have some responsibilities financially. Right. So then left that and that's when I went into pawn shops and the video game company, kind of as mobile phones and social media were starting to come on. So can pause there and kind of take it wherever you want to, but those were.
Yeah, I remember seeing Easy Pawn. I knew a guy who was one of my angel investors. He was from Israel and he had a string of pawn shops in London, and it was minting money like crazy. It was just like a venture debt firm that never loses. They either get a huge arb on it or they get like a massive yield if the person comes back and gets their, grandmom's diamond ring back.
Yeah, that's right.
You know, and then a lot of fintech today is rethinking how a lot of this stuff works. I could see that, generating, good returns. So from when to when were you? We had three startups. Roughly what years were those? And you
So,
know,
so 2007 is when I left. 6 and 7 is kind of when I went off from Virtus and started working on the next phase.
Invertis is an entrepreneurial endeavor as well, right? Because you're a co-founder of that, and
Yeah, co-founder of that. I mean, founding a fund is different than founding an operating company. I mean, it was, first time for any of us GPs. There were three founding GPs there. The one that, really rose to kind of be the captain of that sort of industry and that franchise is Terrell. And he's an amazing investor. But he loves real estate. He's a lawyer. He's a what could go wrong, guy, conservative, very into structuring things and, kind of squeezing all the yield out of a stone. And so it's perfect for him. He's been extremely successful. In fact, in this market right now, I'm really glad that I have a lot of Virtus because it's proven to be a safe haven and kind of some other choppy waters, but it's not that rocket ship of excitement and kind of, fast wealth creation and sort of, um, high alpha sort of talent that kind of flocks into, tech companies or venture, right? It's just a different breed. I mean, I think my big learning from that whole thing, as far as being a manager of a fund that's not venture, is that all asset classes are created differently. They're not equal, for sure. They're different. And because of that, certain talent that wants to be part of high growth and the chance to make a lot of money in a relatively short time frame, but also with some risk. Those type of people aren't going to show up at an infrastructure fund or a real estate fund or some other steady as she goes thing. They're just not. It's not in their DNA. It's not what they want to spend their time doing. And so leaning into that full tilt is actually really helpful. If you want to hire and rally these types of people, and I think this works for operators too, right? If you're a tech company, the type of talent that's going to resonate with you as a venture-backed startup and who's going to self-select to be part of that zeitgeist is going to be different than somebody who's going to go join IBM,
oh
right?
yeah,
And so lean into that, right? Like that is what it is, and there's magic in that. So
yeah. I mean, sometimes we like having those. Like I have buddies from all the big tech titans of Silicon Valley who have made so much money on their options at Cisco, VMware, Google, Facebook, Amazon, Microsoft up in Seattle. And they say, "Oh, I'm thinking about maybe joining a startup." And I'm like, just stay where you are. Stay where you are at Microsoft. You've been there for 18 years, my God, and keep funding startups through us, and we can have you on the board. So it's like, it's almost good to tap into those people as a network and don't let them all go jumping off a cliff, starting up companies or starting up funds. But talk about so ATX, if there's anybody who doesn't know, that's basically the acronym like NYC is New York City. This means Austin, right? So maybe talk about the birthing of ATX Ventures. And you guys have really grown up. You're now going into Fund 4. And I believe, is it safe to say you kind of crossed that chasm of what, 500 million AUM?
yeah, we're about at 550. So we crossed that over.
550. Well done. Yeah.
Thanks. It was not
Yeah.
easy,
So
for sure.
yeah. I mean, when you're starting off, you think, oh, this first fund will be so big, and then it's not, and then the second fund has its own unique challenges. And Fund 3, Fund 4, we were
Yeah,
saying before this that a lot of guys don't make it to Fund 4.
that's right.
That there's a certain kind of like, you know, late seed to Series A crunch, and it's hard getting Fund 3. And I know John Frankel from FF was telling me, Fund 2 will be easier. Fund 3 will be the hardest. If you can do Fund 3, then you're on a tear. And he was telling me that when I was on my Fund 1. Um,
Good advice. Yeah,
yeah,
fun three is definitely our. I think fun one and fun three were our easiest. For me, fun one was pretty easy because so I was actually a solo GP in fun one. It was called ATX Seed Ventures back then, because we thought seed was going to be the new Series A was kind of the thesis. And as an operator, I'd seen that, right? I'd had my software company for pawn shops. I'd had the early social mobile video game company that we took public, right? So I kind of was there for this Austin not being a two-tier city, because the reality is operators see things first. I mean, we're hand to hand with customers and competition and hiring. We're labor arbitraging. We're going to where we think are the fertile grounds to grow our franchises are. So we all saw Austin as operators before the GPs do, because the GPs don't know until they start going to board meetings and they start mapping out, hey, we've had, a third of our portfolio company look to expand offices in, Austin or Boulder or Salt Lake or whatever, right? And then the LPs don't even know that until the annual conference, and then they map it out, right? So there's kind of this information delay from what the pulse actually is on where there's opportunity or employment or labor or intelligentsia or capital dislocations, right? So we all saw that firsthand in Austin. I mean, you actually saw it, significantly early. And so we said, hey, look, we're all limited partners. I mean, after my exits, I'd had a private equity buyout, strategic acquisition, and an IPO as an operator, right? So
Good.
kind of all three ways you can make money, and they're all different. And there's a nuance each of them that imprint on you and how you think about term sheets and liquidity. And now that I'm on the investor side, each one of those chapters as an operator and how I made my money, and the challenges and nuance around how those exits work is very real. And because we've now had those all happen, except for the IPO, both of our IPOs got shelved in ATX, our fund. But, that really has helped me help some of the founders navigate those exit conversations, having kind of been there, right? In their shoes. But yeah, so then we were all here in Austin, and there was kind of, there wasn't 100 amazing tech companies, all
So
venture backed.
what year was your ATX seed fund? What year did that get going?
2014, and we did that specifically in
Okay.
2014 because before it was basically, I'll say kind of the League of Justice kind of thing. It was all these founders with exits that had West Coast funds on speed dial because we'd made them money.
Like Mike Maples you're talking about, or
yeah, this would have been Mike Maples' time frame when he was actually running Motive back. This is before.
I worked for him. I ran Europe for Motive.
Oh, right on. So okay, this would have been before he made the VC leap, right? I'm
Yeah, so
actually.
I was in with they're all Tivoli guys, and
Yes.
and so I had to be back in Austin for board meetings. This is where it didn't make it past all that bourbon, and so I was coming to Austin then, and even before then, we were coming here because IBM was hiring all 1099s and like tons of IITians and shackling them with they had issues with their H1Bs,
Yep.
and they were kicking them out the door of IBM every 18 months because they last thing they want to do is pay for healthcare insurance or pension risk. And so we were just hiring them and having them do Unix stuff for us. And so we knew Austin was a gold mine, labor arbitrage. You pay your guy 150K in the 90s here, and they would be in a house that today would be going for 5 million, right?
Yeah.
Which would be a 40 million house where I used to live in Silicon Valley. So if you want a bunch of happy engineers, you should consider Austin. Right?
Yeah, and I think that, the work-life thing for a lot of those folks too, where, hey, I can't really scale up a family in Los Gatos, right? And so I think that whole dynamic of the traffic wasn't too bad back then. The dollar went a long way. Spouses would be happy, and or if you were single, right? I mean, there's a different dynamic in the Bay Area as there is in a big Texas college town too, right? If you're a high paid engineer. So I think just like even the fun factor for the high paid tech worker in the Bay Area versus, a big college town is just different, right? Where you're
Sure.
where they're in the composition of those in the marketplace is also different, right? So it kind of worked for everybody.
So how do you maybe tell us your view of the story of Austin as a tech corridor innovation hub? I mean, you had a couple big companies. AMC was here very early.
Mm-hmm.
Michael Dell was in his dorm room at UT Austin making PCs. Where have we seen the migration of the types of technology that has been successfully born in Austin?
So really, I mean, we were more of a hardware. I mean, this was a big semiconductor city. I mean, in some ways it still kind of is, but it was big hardware, big computers, big semiconductor. On the software side, that there was the Tivoli. I mean, there's National Instruments, which there's some of the testing companies. There's VMware. There's plenty here now, but it wasn't always like that. It was more of a hardware, firmware with some software that supported them starting to come into the space. That all changed, and then there just wasn't much capital democratization. There were sort of two funds that kind of covered Austin. And if you actually talk to the West Coast like fund managers of that vintage, I mean, I've had a couple that are mentors to me. I think it's really important for any founder of any business is find somebody who's walked the trail ahead of you and kind of learn their wisdom and serve them and so it was kind of considered a tier 2 city for all the right reasons, right? We just didn't have the density of founders, of executives to have enough critical mass to where they would plant a flag here. And so it was kind of cute and known, but not necessarily obvious. And you wouldn't spend a lot of energy on it because there's so much stuff in your own backyard. How that really changed, though, is I think people started moving here on the operator side, right? So the talent started coming, and then it started coming, and then the big company. This is Oracle's headquarters now, right? I mean, they're bigger here than they are in California. I think it's like second city most for Google, Facebook, Drop. I mean, test all.
By the way, that is just so important because like you can be like, okay, I'm Emmanuel Macron. I'm going to overnight give tax breaks to anyone that puts money in a VC fund or a startup. And overnight, you've got 200 new freshly minted VCs in Paris. But who's going to buy those companies? Show me the big balance sheet buyer. Show me that spiral of like Austin, I think, has always been good at enterprise software where they know how to like raise some money. Maybe they got it in California in the old days or AV here. And then they get some logos, they show some traction, they go back and raise at a higher valuation, they spend more, they build more, and it kind of upward spirals like that. But who's going to buy your company if all the buyers are in Silicon Valley and Seattle? It's less likely that they hear about you at like a lacrosse game with their kids and all that. Now we've got Oracle, one of the biggest buyers of not only enterprise but consumer companies, and they have their M&A corp dev team here in Austin. That was a big signal, seeing those guys move.
Totally agree. And I mean, I remember the days, back when I was an operator, it would be a term sheet contingent upon relocation, right? So here's your Series A, you got to move your team to Austin, or Series B, but you've got to move most of the team to Austin and take the nerd bird, every Monday and come back Friday kind of thing. So it was a real thing. Like if you want our money, you're coming here. And it absolutely flipped to now it's, oh, by the way, when does your lease expire? Can you take more real estate? Can can you build your team there and actually take people out of California? So it's really interesting how the pendulum completely swung. But we were, and you said you're right. I mean, the muscle memory here of this town was very much an enterprise software town and kind of hardware, semiconductors. And when I had the video game company, I mean, when we did Sneaky Games Zatica, right? That was part of a vintage. And I think this is really important for anybody to really think through is when you're part of a movement, right? Say it's the beginning of the browser, or it was, when, console and gaming comes, or console goes to web and web goes to mobile, right? Like these new paradigms create a Wild West environment. So an empty app store, if you will. So that's a great place to be. Because those people, even though some folks, I mean, Zynga, Playdom, Digital Chocolate, Kabam, like in us, like that was it. Like we were the top 10 studios that had the most, daily active users, monthly active users, most ARPU. We were all known. I mean, it was published every day.
Yeah, I remember Kabam. I remember meeting those guys. They almost joined the Founders Club. The valuation was big.
Well, they all raised a ton of money, and so in Austin, we'd raised less than 3 million, and we had for a while 2 of the top 10 games. I mean, next to Zynga and stuff, right? And it was blowing people's mind because they had all raised 50 or in some cases hundreds of millions of dollars, and we'd raised less than 3. And everybody wanted to try and open an Austin studio because remember, this is where Origin was. BioWare had a big thing here, NC Soft. So there was a lot of video game talent here. But back then, it was enterprise software town, not a consumer town. And, the video game side, it was all microtransactions and virtual goods and freemium, part of that whole dynamic. And so I still keep in touch with a lot of those folks that worked with me back then, and they've gone on to multiple companies. Some of them are even in the portfolio. Our international dev teams in Argentina, we still use from way back then, just because they're great engineers and developers. And I think the great thing about video game developers is they think with a UX lens. I mean, they're not just slinging code. They're trying to create joy, because that's part of what a game developer does, especially a game developer who has to live and die by a microtransaction. Or if you're freemium, you don't have the luxury of like, big fat enterprise check. Here you go, vice president, get butts in seats, force the installs, see you next year for the re-up, right? I mean, everybody is very ADD, and if you don't provide value and it's not exciting, they're out. And you're just
It's like Roel and Vivek from Superhuman. Vivek actually moved here. He was the original CTO. They built that product for email with a video game mindset. They just said, all right, if video gamers were to reinvent Gmail now that computers are 1,000 times stronger, how would we do it? And it was a total video gamer mindset to attacking something as mundane as enterprise email.
I love it, because it's funny, because back then, very few peers here, other than a couple marketplaces, right? It was like the U-Ship guys, HomeAway, Verbo. There was a couple marketplace folks, so we still would talk about the consumer side, but it was truly camps, like you joked about, B2B versus B2C. All the investors in Texas, especially Austin, were all B2B. Most of the operators were, and the consumer folks, we were like the little kids at the Thanksgiving table, and over here were the big adults.
You're the beginning of a movement, because I think the story of Austin to me is that you could trace it to IBM, and you could trace it to like standard query language. SQL was developed by Frank King at IBM here in Austin, and obviously semiconductors and all those things. But now, it's a good thing that you are into real estate, my friend, because a lot of people come in here. They're coming from everywhere. Like, I think there's a huge amount of people that are, I mean, Austin's got a lot to offer, but it's more like LA, New York, and the Bay Area are pushing people out, So I think that right now it's game on for just about any industry in the venture capital startup world. What are you seeing?
I think so too. I mean, you've got you've got enterprise and consumer both with legs here. And this has actually become a pretty strong consumer town. I mean, you've got, Whitney over there at Bumble. You've got, the Chive guys. You've got content. You've got dating and e-com. I mean, one-on-one. You got a lot of the supply chain stuff and the fulfillment stuff as well. I mean, Amazon's got a big presence here, so it really is much more diversified as far as the talent and the capabilities in the market. I think we're still underserved by sophisticated capital at the early stage. There's
it still feels a little like sometimes you're like, oh, thank you for flying Delta Airlines. We knew you had a choice of American or United. That was the only choice you had. So it was quite monopolistic, and so everybody hates Delta. But in Silicon Valley, it's like, oh, thank you for choosing our venture capital fund, because we know you had 100,000 choices to choose from. So the mindset coming from San Francisco and New York, where I've had my offices the last 15 years, was very much a services business, where it felt a little bit like, all right, here's some money, I get half, you do the work. It was like a very different model for some of the VCs going back to the AV days, I think. So I think the venture community here is changing by the minute.
Yeah, it really is. I mean, I would say twice a week, I just do coffees with new arrivals, right? Like, so they're, analyst or associate from big, tier one firm that's thinking about moving to Austin, or is moving to Austin, and they're trying to, market map and get to know the other players, or big founder operator that's moving here or thinking about moving a team here, or already moved here part-time, and has residency and now is trying to do the full move. So there's a lot of that going on. But I spend a lot of time with the buyout folks, just because, I came from private equity on the real estate side. I know what kind of, $1 billion plus AUM sort of looks like, and those conversations and how you build those firms is different than being a minority investor. So I spent a lot of time. We sold a company to Vista, love Vista, have a lot of friends there, and some shared operating partners and LPs even. So I think it's really good to talk to the folks that are downstream because, and they want to talk to us, right? I mean, they're not launching companies, they're optimizing companies, right? So there's definitely a value exchange. I mean, that's one thing I would say is, there's a lot of hedge fund folks. My co-founders from big hedge fund land, have several hedge fund LPs. Hedge fund that we're the canary in the coal mine, right? Venture is the future. That's our job. Now, the timing, the underwriting, all that other stuff is its own animal. But anyone downstream from us really does care about what we're seeing and what we're doing because it affects their big companies, right? Venture affects buyout, which affects crossover, which affects hedge funds. It's just how it works, right?
Yeah, the whole crossover thing really changed the industry in 2020, 2021. It's interesting to see how private markets are so liquid. Yet we've got like Gordon Gecko, legal formalized information rights and pro ratas. And then those guys have always operated in the public markets and they're now figuring out, how to play into ours. But 2021, I think they were overpaying for everything. So let's cover ATX Venture Partners. So the
Sure.
first fund was seed. Let's talk about your evolving portfolio construction of just go through fund one, fund two, fund three. Fund one, how many companies? How early were
So
you
Fund
investing?
One was 16 companies, and Fund One was me, a lot me, and then Solo GP, my admin, and everybody that I had made money with and for that I liked. And so
Right.
really it was, my old co-founders, some of my executives, the family offices that backed me, principals at firms that had backed me, and other founder operators in Austin that were dissatisfied with the venture capital status quo. So
Mm-hmm.
kind of, early investors, hands-on investors, smart operators that said, look, there either isn't institutional venture capital here or that venture capital that's here, I don't want involved in my next business, and I want to do it differently, right? So it's
Yeah.
kind of that
Yeah.
builders thing. Before it was really a thing. I mean, like seed is now a known asset class. This was heresy back then. It was like you're launching a fund. The only other fund you've done before is real estate. That doesn't count. You're an entrepreneur. You're first time fund manager. You're solo GP. And these are all like scarlet letters, bam, 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 to in a row to the institutional allocator. And this town is full of institutional allocators. I mean, big, big pensions, right? So we know them. They're easy. You can grab a beer with them. I mean, like we just go back. We
Yeah.
share community, but they're like, look, you're a first time fund manager that didn't roll out of a tier one fund. You're pitching this, your name is ATX Seed Ventures. Oh, this is literally when Mike Maples was doing Floodgate. He left, right? He's in California. So, I mean, it was like institutional money did not want that story. They thought it was amateurs and angel investors and gambling. And in many
Oh,
ways,
I think
they were
Mike's
kind of
done
right.
well though at Floodgate. I mean,
For sure. For
we've
sure.
co-invested with him a bunch of times and know him, and he's an operator turned VC like us.
But he
So
left it out there, right? So I mean, like he went to the right place. Like that narrative would there's more smart ears for that narrative to fall on in that market. We
yeah,
stayed low.
also you hardly need to put your hand outside before you touch somebody who has an exit, who's unsatisfied with the VC status quo and all that kind of stuff, and then
Yeah.
they want to be part of it, and you kind of replicate yourself with all that network. So by fund two, now you brought on two more GPs.
Yeah. So how it worked is fund one, it was all non-institutional operators helping operators, and we led. So we were doing club deals before. So not too uncommon to a lot of fundless sponsors. It was just, we saw, right? Like we get on cap tables, we see deal flow, it's people we know, or we're getting things kicked down from funds that we were in the operator sleeve of their fund. And so we already know the downstream round can be taken care of, but it's like the blocking and tackling of who's gonna stand up our seed
Keep
round.
going.
So it was only seed. So it was ATX Seed Ventures. We led seed rounds, and we always led. We wanted to, and our founders wanted us to. They were like, "Look, I want you on the cap table, and I want you to have the board seat. I want you to price my round, and then we'll fill in with option checks from downstream funds or strategics or whatever." So we led only, and then we co-invested. So we were built day one for co-investment, which was also really tough back then. Now I think it's all the rage, but early on, institutions weren't really set up for co-invest. Primary funds were easier for allocators, and we didn't want any of that. I mean, we wanted to write checks and founders and cherry pick which. I mean, the enterprise people wanted enterprise, right? You know, the consumer people wanted consumer, and you know, we wanted to actually use the fund to administrate space in governance for us to then co-invest in at seed Series A. So we put way more money to work in co-invest than we did in our primary fund because that was the goal. And so then on fund two, we quickly learned, hey, this business of being a fund manager is a real business, and Austin is really on fire, and the seed stage thing is really working. It is where the sort of alpha to be had and the dislocation is in the market, and we wanted to go put the gas pedal down. So I was like, all right, well, I can't be a solo GP, and I need to have somebody that I know, like, and trust that can build this firm with me. So I called my old grad school buddy, Brad, who worked with me at Virtus. It was my first hire there. So we'd already worked together, built something together. He came on board as a second investment professional and co-founder. And then we ran a big sort of recruitment campaign where, I mean, I don't know how many interviews we had as far as finding a co-founding GP that had built a notable franchise. And we joke internally, you know, we found the perfect woman and she's a great partner, but we know it's like we recruited Picasso to paint our garage. I mean, if you look at venture is, you know, smaller than buyout, is smaller than liquid. So the liquid strategies people, I mean, to them, I don't want to say we're a joke, but venture is cute, right? Like
Yeah.
we don't have daily
They're
trades.
like, where's the word redeem? Like I don't
Yeah.
see the word redeem.
So that's what we did is we're like, look, and plus we couldn't really find anybody who had built a small venture firm because the AUM is too small. Most of them can't afford a non-capital facing or non-investment professional, right? I mean, if you're managing $100 million, you're either doing investments or you're raising money. You don't have a lot of ops cost. And so we, you know, being a builder, like, I mean, I've built companies, I've built funds, you know, you have to do that. And so you kind of, is a rare GP who either have to have the financial wherewithal to personally just pay for it and do it because you know how to build a franchise, or you have to have some way to get the resources to attract someone like that to your firm. And so we found Danielle, and Danielle was on the early team at Perry and then at Millennium. So she, you know, took them from what, like 5 billion to 50. So she was used to, you know, marketable securities and, you know, international sovereign wealth funds and managed accounts. And I mean, the complexity that she was used to made this kind of a walk in the park, almost a joke, being in the land of privates, right? And so she's a co-founder and partner of the firm. And she built out our co-investment process, made us institutional. On fund two, we went institutional, got institutional LPs. We have international LPs, you know, Cayman feeder, Luxembourg feeder, you know, multiple vehicle funds. We have managed account. I mean, the whole dynamic. So if it hadn't have been for having someone like a Danielle, we would just be kind of the same old of how many smart, you know, Mensa folks with high EQ that can see around the corner and manage money. Like, that's not, you know, who's not. Like, show me another, you know, dude who's, you know, can see around corners and has founder empathy. Like, those are just table stakes, right? But to find somebody who can build a franchise that can digest international institutional capital, that's a different animal, right?
And so we need to wrap up. So to fast forward to right now, what stage geography? I mean, obviously Austin is a key target, but you've invested outside of Austin too, right? So
Yeah.
what are your quick stage sector geographies for right
So,
now?
so geography, we don't claim to be, you know, geographically focused. We don't really lose in our backyard, just because, you know, we're founders helping founders. That really works for us, and we're on our fourth fund. So a lot of folks who've actually backed a couple times now over, or an old, you know, executive from one of our other companies has rolled out and we backed them again. So we've got a couple repeat offenders, if you will. But we follow themes. So our themes are largely end-to-end supply chain. So make it and move it. So anything from manufacturing to assembly, you know, fulfillment, trains, planes, automobiles, ships, maritime port, warehouse. inventory either arriving, something arriving at your doorstep, last mile, or on the shelf, inventory management. So that whole time continuum, we've been investing in that since day one. And we have some of the best LPs in that market and operating partners like early supply chain Dell, big trucking families, large maritime families, right? So we actually have a lot of edge in that space, big retail families too. So we kind of see that and get that, along with energy and real estate. And then the other one has been future of work. And that wasn't really a thing. I mean, you'll know this too, just given your background, but if you were building a company in Austin, you lived remote work. Like I can't, future of work to me, it's like, well, who didn't have international developers, who wasn't doing collaborative tools? I mean, when COVID happened, everybody had to learn how to use Zoom, we're like,
yeah, I was on good. I figured out there was a time when I was doing the Founders Club that everyone's like, oh, call me on my cell phone in Stockholm for a 1 hour call at 53 cents a minute. And then call me in Tel Aviv and call me here. And GoToMeeting was $60 a month. And you had Zoom, you had video conferences, and everyone's got a local dial-in. And so I was like, hey, dude, let's do the video. It's way better. Like, no, I'm old school. I don't want you to see me. Like I couldn't get anybody. I've been pushing the barrel up the mountain saying I'd much rather do a video call than audio only. And people are like, no, I don't roll that way.
That Sisyphus dynamic, right? I mean, like it did feel like until all of a sudden you're like, it's like a flywheel, you're pushing until you're not, right? And then everybody now is clamoring for it. But those have been the two themes. And because those themes are global, our portfolio is global. And we have companies in Turkey, a couple in the UK, Latin America, and a lot of them have multiple offices, right? So it's not just like you have one big giant campus and everybody drives in and parks in the garage. I mean, some of our companies have, 5 offices around the world, call centers and customer success and, Indonesia, development and, Eastern Europe or Poland or Argentina, it's just, that's how it is. So I'm overweight industry theme where you have a long-standing knowledge set and partners globally that can help you have a better lens and sort of de-risk go to market, as opposed to I want to see every opportunity in Austin. I think actually any fund that's hard, that's fist pounding geographic only, I think they are doomed to fatigue out. I think regionality is the least defensible moat in venture.
But that it's usually LP driven, right? They usually have an LP that says you have to invest twice our LP commitment into this geography in order to, so and we are creating jobs and payroll tax, and we're doing good by the taxpayer. And I actually think I'd rather know my tax dollars went to that than to whatever else they screw it up with. But I would agree with you.
You're so right, man. You're so right.
If you can, I mean, one of the benefits of being older is that someone that you hung out in that, that clown car in Miami a few years ago shows you a deal, and it's not in Austin, and you get to back it. Like, have you ever come across Easy Ship? By the way, we found that company, and it's probably too late stage for you now, but you were just describing Easy Ship. And like basically anybody can have exactly what Amazon Prime does, and even maybe cheaper, like for anybody. You're a little glass blower in Montana, you're now as good as Amazon. And they were born in Hong Kong, and we got them to relocate to New York, which they wanted to do. And so they found us. And then it's grown into a huge company with, people everywhere. But closing comment, with all of your experience from real estate into where we are today, do you think pre-money valuations in private startups across stage are going down, going up? Do you think that property prices in Austin are going to go down for 6 months and then go up? What's your kind of macro? I know VCs are not meant to be macro guys, but we're kind of forced a little bit to talk to each other about it. So I'd love to get your data point.
No, I spent a lot of time on macro, actually. I love my hedge fund buddies. I think it's important. I think Austin is going to slow. I mean, there has been more time, like days on market for residential, but you're not seeing a lot of price point. You're seeing some price point corrections. I think people are like, well, it's been sitting, I'll mark it down a little bit. I don't think there's going to be a big dip. There wasn't a big dip here. So the first time, like we were kind of fast out, like V-shaped recovery, because I think the jobs are still coming. Like as long as the jobs come and there is this tax, labor, quality of life arb, then for sure. I think that commercial real estate for sure is going to slow people, especially depending on when you bought that dirt and what your development costs are. But I think the residential is definitely slowing, but I don't see a big, there's not going to be like a fire sale. Like, I don't
Yeah.
see that happen. But I do think that on the valuation side, the velocity, I mean, if you talk to anybody in the market right now, nobody wants to sell. It's hard to raise. A lot of people are sitting on their hands, and it's all cascaded back from kind of comps on the publics, hitting crossover, hitting growth equity, and it rolls back down. Now that bullwhip diffuses, right? You can only go down to zero, right? So if founders are like, look, I'm only going to sell 20 to 25% of my company in this round, well, there's an implied pre-money on that makes that math work. So what I think's happening is that the A and the B, really the B, that's the has to be bought right check, because you can't just get that growth equity velocity like you used to. And so, they're not overpaying right now.
Yeah,
And
I think you had, I mean, there was a company that was trying to raise 25 on a pre of 125. I've been tracking this Valley company from inception, and I'm friends with all the other investors. And then I said, I think you should raise a smaller round and keep it to 20% dilution. And so we ended up doing 7.5 on like 30. And that was in
wow.
October of 2021. So that kind of spring, summer was thawing by August, if not July, of like, what is happening here? And then by deals getting done by like October of 2021, and then 2022, the crossovers were out, and you had the invasion of Ukraine, and inflation out of control is here to stay, and things got rougher. But I think that the answer is smaller rounds, and if you're in that B zone, you should try to plan for profitability if you can,
Yes.
and
Yes.
not the old. We're in the business of selling $100 bills to customers, and they pay us $50 for that, and then some crossover fund's going to pay for this party, you know. So it's like, consider the smaller round without too much dilution, and just be really careful with austerity. Make sure this stuff works.
I think that's good advice. And there's also a ton of money that's been raised on the sideline. I mean, how many bigger than ever, faster than ever funds came back to market end of 21 and, kind of Q1 first half of 2022, right? So that money can only sit on its hands so long, because they all have their 10-year funds, and
Yeah.
LPs want money to work and stuff. So what's going to happen is it's already happening. There's a flight to quality and metrics that wasn't as prominent in early stage, 12 months ago. I think there's going to be a washout of funds that, had never been fund managers, and founders that had never seen money not available or not up to the right chart or whatever. Right. So I think that's all sorting itself out too. So the plankton are starting to wither and or go away. And so those that are still around, that are anchored, are going to have a really interesting time to be there. I think the big franchises that have a bunch of powder, that's a blessing and a curse, but at least they're here, right? So just being here, or an operating company that's here. So, what happened is, a dozen companies would all get funded by a bunch of funds that didn't do or didn't care about like the competitive landscape, because money was fast and a lot of talent. And then it's too many, right? Like that TAM's real, the market opportunity is real. Can it be served by 12? No, it'll be served by the remaining 3. So I think that's what growth equity wants. That's what buyout wants, is they want this consolidation of available targets that are really tight in their operating performance, that can take big checks. So that round you talked about doing, we've done a couple of these too, where it's like, you know what, let's hold off on the B, tighten our belt, get our metrics to, if this is what the market wants, we want to over deliver on that. And then I think what's going to happen is we're actually going to go out and raise kind of almost a Series C type round. So some of these smaller funds kind of call it the 200 to 400 million. We can do an A, we can do a B, little of this, little of that. There's a lot of that out there. And, you start throwing down 20, 25, $30 million ARR with good numbers, you can sprint past them and be like, how you were giving us a hard time about the $20 million check or the $15 million check. We're raising 75 or 50 now. I think that in 12 months, the companies that are left that are high quality are going to sprint past lower growth equity generalists and go either for like very strong thematic expert kind of funds, vertically focused funds, or the big sort of franchises, right? The Warburgs, the GAs and stuff like that, the Spectrums, the Summit, whoever, you name them, right? Like, Excel KKR types that are trying to king make on industries that have already known it and they're already poking at your CEOs. I mean, I can't even tell you, once you know how it is with your portfolio, once you get those companies that are your good ones, they're already market mapped. Like the iBankers, capital markets know them, the buyout funds know them, the growth equity funds know them. They're just trying to wait for the puzzle pieces to fit, right?
Well, it's interesting you say this because if that's true, those would have big valuations if they, leapfrog over the B rounds and the C rounds and they go straight to Summit, who's usually, I remember Summit saying, we like to invest within 6 months before a liquidity event. I was like, really? Like, really? We're willing to give you some liquidity too. Like, we'll pay off some founders, out of the round with some secondary. That was like forever ago. But I just thought that was like hilarious when you look at, I started off jumping out of planes and then building companies and doing the hard work. But listen, Chris, great to see you here. Thanks for coming on. Let's get together in person real soon.
I love it. Thanks for your time. Good to see you.
All right, bud. See ya. Bye for now.